Welcome to WealthEchelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control of your wealth journey. One of the best ETFs on planet Earth is QQQ, which has a 10-year average return of 17.38%. VGT has a 10-year average return of 19.6%, and VTI has a 10-year average return of 11.15%. Having those three together in a supercharged portfolio full of heavy hitters would be making you bank. With returns like that, on average between the three, that's like a 15% return. And if you were investing just $500 per month with a return like that, in 25 years, you'd have over $1.3 million off of just investing $500 per month. To make returns like that, you're going to want to make sure and cut down on any mistakes in ETF investing. And in this video, I'm going to go over 3 huge mistakes and how to fix them to be a very successful investor. The first has to do with what I just started with, and that's looking at just total return. Here's the thing about looking at just that total return though. While each one of those ETFs at the beginning of this video was solid and had obviously an amazing return, picking only the top ones with the highest returns for your portfolio total may be a huge mistake. When we look at QQQ and VGT, those first 2 ETFs, the first one was QQQ, and as you can see here, it's huge in technology. Over 57% is all technology. The top 10 holdings are reputable names like Apple, Microsoft, Amazon, and Nvidia. But when we look at that other ETF, VGT, we can see that it is full of all information technology. So while QQQ was 57%, this is 100% information technology. So you're getting the same thing in 2 different places. And when we look at the types of companies that are within VGT, we see Apple, Microsoft, and Nvidia again, and specifically 40% of this is in Apple and Microsoft. QQQ and VGT overlap. So when we look at these two and the overlap between the two, you can see that 33% of QQQ's holdings are also in VGT. As far as weight, about 50% is weighted between the two. This means that you're basically buying the exact same thing or very, very similar things, just paying for it in 2 different places. If you're buying QQQ and it has a high amount of Apple and Microsoft, and then you're buying into VGT, which has a super high amount of Apple and Microsoft, you're kind of just buying the exact same thing but putting your money in 2 places. Like I said, this isn't necessarily a huge wrong, but it could be, and the way some of you are doing it definitely is. Now yes, there's obviously going to be a bunch of overlap between a fund whose big priority is technology, which is QQQ, and then one that's literally called a technology fund, VGT. So you can see the similarity there. One that a lot of people kind of forget about is when you're having that foundational type ETF, one like VTI. Most people have either VOO or VTI in their portfolio and then add things to it. QQQ and VTI overlap. So when we look at QQQ versus VTI, we're going to see that there's still a huge amount of overlap, especially by weight. Here, 93% of QQQ's 100 holdings are already in VTI. So if you have VTI and you're buying QQQ, you already have 93% of that in your VTI exposure. You can also see down here that we have a bunch of overlap in these companies: Apple, Microsoft, Amazon, Nvidia, and Google. But the mistake is not what some people would make you think. There's a lot of people that think that fund overlap just by itself is a bad thing, and that is incorrect. Just because you're buying something that you already have a little piece of over here doesn't make that bad, especially if the company's good, right? Like for me, I really like Apple and Microsoft, and I want a bunch of that in my portfolio. Those are the 2 biggest companies that we have, and 2 of the strongest, and long term, I see them having a competitive advantage, so I want a lot of exposure there. So it's not fund overlap that's the problem. The problem comes when you don't understand what the overlap means and how it actually affects your portfolio overall. The main takeaway from this, point number 1, is that you need to understand that you do have fund overlap if you have it, and then how much of it you actually have. So in the example that I've gone through so far, we looked at QQQ, VGT, and VTI. As long as you understand all of the holdings within all of them, and then how much of a percentage you actually own, and which ones are higher weighted than others, that's going to be important for you moving forward. Because you should understand that in each one of them, you're buying into Apple. In each one of them, you're buying into Microsoft and Nvidia. So then if you're looking to invest in an individual company and you want to add stock to that ETF portfolio, it's probably not the most beneficial idea for you to add another share of Apple or another share of Microsoft because you're already so heavily weighted with what you already have. But if you do your research and you just really like that company and you are totally fine having 50% of your total portfolio be Apple, that's not the craziest thing in the world as long as you understand that that does have a little bit higher risk. But the best investor to do it does have a portfolio with a very high amount of just Apple. So understand what's in your portfolio, understand what fund overlap is, and then make your decision off of that. The next mistake, and number 2, has to do with diversification as well, but this is one of the biggest mistakes that I definitely see happen all the time. It kind of piggybacks off the first one, because traditionally the way to invest, the most optimal way to invest, was this idea that you should have very little to no fund overlap whatsoever. Everyone agrees that a portion of your portfolio should be U.S. equities or U.S. stocks, and that would be a broad index fund like the S&P 500 or the total U.S. stock market. That's the first part of the 3-fund portfolio. Then, in the old 3-fund portfolio, they wanted something that was also stocks, but totally opposite from that first part. So if the first part is U.S. stocks, the second portion needs to be non-U.S. stocks, just international exposure. Then the third part of that fund is totally different from the first two because the first two were stocks. So this third one is not stocks, it's bonds. Obviously, the problem with this old 3-fund portfolio is the fact that we've seen the data over the last 20 years, and it's not so hot for those last two pieces. VXS would be that international ETF, and over the last 10 years, the return has been about 3.7%. As far as the bond returns, the BND ETF return has been 1.3% per year. Those are awful. The biggest mistake anyone could make in this investing world is just to take somebody else's word for their investments or look at their investments, just copy it without doing any extra research yourself, and not understand what it is that you're investing in. You need to understand not only the investment itself, but also what your total goal is with your portfolio. My 3-fund portfolio is the best place to start because, especially if you're new to investing or you need to revamp your investment portfolio and get it rebalanced, these 3 are where 90% of my stock and ETF portfolio lies and give you all the great things that I talked about in this video, especially a monster long-term return with consistency and safety. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and turn on notifications so you never miss an update. At WealthEchelon, we're all about helping you navigate the world of crypto, investing, and financial growth. Have any thoughts or questions? Drop them in the comments below. I'd love to hear from you. Stay sharp, stay invested, and I'll see you in the next one.